Welcome, everyone, to our next episode of Value Investing Talks in our series on investing. We have a very, very special guest with us today. He's traveled all the way from New Delhi, where he's a professor an adjunct professor at MDI. He teaches a very popular course to the MBA students over there, which is titled Behavioral Finance and Business Valuation. He also blogs at Fundu Professor, and I've really enjoyed reading some of his articles there. So the nice thing about Sanjay is that he's not only a teacher, he's also a practitioner. So in investing, it's very interesting when teaching and practice meet, and we are really looking forward to learning from your insights, having worn both those hats. And he's one of the few who eats his own cooking and teaching, as you could say. So without any further ado, ladies and gentlemen, please join me in welcoming Sanjay Bakshi.
Yeah. Thank you, Saurabh, for inviting me here. It's a pleasure to be here. It's a wonderful campus, and I'm delighted to be here with you today. My talk is titled The Prejudices of Mr. Market. But I would like to talk to you first about an unusual subject called empathy, which is the ability to step into the shoes of another person, aiming to understand his or her feelings and perspectives, and to use that understanding to guide our actions. Empathy. Normally, you don't associate this word with the world of capitalism and investing. And I have to admit that I used to think the same way too when I started out as a value investor about 21 years ago. But today I think differently. Today I think that every value investor should count empathy as one of the key tools in his or her toolkit. Today I use empathy to really understand a business and its market valuation. Let me explain how. I'm a value investor who focuses on investing in moated businesses in public markets in India. A moat, as you know, is a metaphor that Warren Buffett uses to illustrate the idea of a competitive advantage. And in one of his various talks, he said that what we're really trying to find is a business that for one reason or another has this moat around it. And you throw crocodiles and sharks and piranhas in the moat to make it harder and harder for people to swim across and attack the castle. So it's a very powerful metaphor. It's quite obvious to me that investing in a business with a moat carries a very low risk of permanent loss of capital. A durable competitive advantage makes a business resilient to economic shocks as well as managerial mistakes. It gives the business what Tom Russo, a wonderful investor who I'm told is going to be here and address you soon, likes to call this capacity to suffer. My own experience of more than 2 decades of value investing has persuaded me that investing in a business with a moat is likely to deliver much higher returns with much lower risk of permanent loss of capital than investing in a business without a moat. I'm also convinced that buying into scalable businesses with moats at sensible prices and then holding on to them for long periods of time is a very profitable, low-stress investment strategy. But what about empathy? How do I use it for analyzing moated businesses? Well, while evaluating a business for a potential investor, I try to empathize with 4 types of people. I try to step into their shoes with an aim to understand their feelings and perspectives and to use that understanding to guide my firm's actions. Who are these people? Well, they're on the screen here. The first one obviously is the customer. I think it's terribly important to understand well about the pain of the customer that a business alleviates. Why does she prefer to buy from the company that you're evaluating? What's so special about the value proposition to customers that will make them want to come back again and again? The second one is the competitor. Why would a potential competitor not enter this market? You really have to put yourself in the shoes of a competitor and try to enter the market and see what will happen. So there are 2 kinds of situations that I've encountered in a moated situation. One, that there is a moat and people are going to try to enter and they're going to get hurt and they're not going to try again. And the second one is that they can't enter because of some regulatory reasons. There is a patent, for example, or there is a regulatory monopoly. What are the entry barriers? Essentially, this is all about entry barriers. I'm sure you're very familiar with all of that. Put yourself in the shoes of a potential competitor. That's what it's all about. The third person is the entrepreneur. What drives the entrepreneur? Is he what Charlie Munger calls an intelligent fanatic? What struggles did he face in making this business a success? What would he do during tough times? What are his shortcomings? Are they so strong that you would reject partnering with him? Why? And finally, Mr. Market. Why is the stock market misunderstanding this business? What are its prejudices? What will make them go away? For the rest of this talk, I will focus on the fourth person, Mr. Market. The first three are very obvious. I think you all know them very well. Anybody who studied Porter knows about that. But the fourth person, Mr. Market, I think it's something worth knowing more about. Many years ago, Warren Buffett called the stock market as a semi-psychotic creature given to extremes of elation and despair. He was referring to the idea that markets are sometimes very inefficient in pricing assets. In his classic book, The Intelligent Investor, Ben Graham uses the metaphor of Mr. Market, which Warren Buffett has written and spoken about many times. And I quote, Ben Graham, my friend and teacher, long ago described the mental attitude towards market fluctuations, and I believe to be the most conducive to investment success. He said that you should imagine market quotations coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business. Without fail, Mr. Market appears daily and names the price at which he will either buy your interest or sell you his. Even though the business that the two of you own may have economic characteristics that are stable, Mr. Market's quotations will be anything but. For, sad to say, the poor fellow has incurable emotional problems. At times he feels euphoric and can see only favorable factors affecting the business. When in that mood, he names a very high buy-sell price because he fears that you may snap up his interest and rob him of imminent gains. At other times he is depressed and can see nothing but trouble ahead, for both the business and the world. On those occasions, he will name a very low price since he is terrified that you will unload your interest onto him. Mr. Market has another endearing characteristic. He doesn't mind being ignored. If his quotation is uninteresting to you today, he'll be back with a new one tomorrow. Transactions are strictly at your option. Under these conditions, the more manic depressive his behavior, the better for you. But like Cinderella at the ball, you must heed one warning or everything will turn into pumpkin and mice. Mr. Market is there to serve you and not to guide you. It is his pocketbook, not his wisdom, that you will find useful. If he shows up someday in a particularly foolish mood, you're free to either ignore him or take advantage of him. But it will be disastrous if you were to fall under his influence. I think every potential value investor or value investing student has read this many times. So it appears that Mr. Market really is what Warren Buffett has called a semi-psychotic creature given to extremes of elation and despair. Yet he is utterly irrational sometimes, and whenever that happens, value investors are going to take advantage of his prejudices. But here's the thing. If Mr. Market is irrational and stays that way, then how will value investors make any money? For them to make money, Mr. Market should misprice assets only temporarily. And that is exactly what Ben Graham meant when he said that in the short run, the market is a voting machine reflecting a voter registration test that requires only money, not intelligence or emotional stability. But in the long run, the market is like a weighing machine. Therein lies our opportunity. Once we know, one, that the stock market has a tendency of becoming extremely prejudiced against some business which in our view is exceptionally good. Two, such prejudices produce very attractive market valuations for that business. And three, the market would have a tendency of correcting its prejudice over time. We can really understand how to make intelligent investments. If we can understand why the market is prejudiced against the business we love and what will make those prejudices go away, then we'll have a basis for betting against the market. That is exactly what Seth Klarman meant when he wrote about the idea of necessary arrogance. He said that at the root of value investing is the belief, first espoused by Ben Graham, that the market is a voting machine and not a weighing machine. Thus, an investor must have more confidence in his or her own opinion than in the combined weight of all other opinions. This borders on arrogance, the necessary arrogance that is required to make investment decisions. This arrogance must be tempered with extreme caution, giving due respect to the opinions of others, many of whom are very intelligent and hardworking. Their sale of shares to you at seeming bargain prices may be the result of ignorance, emotion, or various institutional constraints. Or it may be that the apparent bargain is in fact flawed, that it is actually fairly priced or even overvalued, and that sellers know more than you do. This is a serious risk, but one that can be mitigated first by extensive fundamental analysis, and second by knowing not only that something is bargain price, but as best as you can, also why it is so. You never know for certain why sellers are getting out, but you may be able to reasonably surmise the rationale. I think Carmen has made a very important point here about the need to know the prejudices of Mr. Market. And many of those prejudices arises out of a shortcut called representativeness heuristic, which means that we look for similar past experiences to make judgments about the probability of future events. So for example, if you run an insurance operation, you would have vast amounts of customer data that allows you to determine future likely behavior of a potential buyer of insurance. You would determine that probability and accordingly determine the insurance quotation based on categories. You'll create these categories in your database. A potential buyer of insurance might, in your judgment, belong to a high risk category because he is male, 20-year-old, young, alcohol consuming, college going student who's never owned a car before. For such a buyer, your quotation for selling car insurance would be higher than that of a low risk category per individual, comprising of, say, a 35-year-old woman old mother of 2 children who has never had an accident in her 10 years of car driving experience. Such type of categorization or stereotyping is essential for making quick judgments in any domain. Indeed, the very word stereotyping has an unnecessary negative connotation. In Daniel Kahneman's book, Thinking Fast and Slow, he writes, stereotyping is a bad word in our culture, but in my usage, it is neutral. One of the basic characteristics of System 1 is that it represents categories as norms and prototypical exemplars. This is how we think of horses, refrigerators, and New York police officers. We hold in memory a representation of one or more normal members of each of these categories. When the categories are social, these representations are called stereotypes. Some stereotypes are perniciously wrong, and hostile stereotyping can have dreadful consequences. But psychological facts cannot be avoided. Stereotypes, both correct and false, are how we think of categories. When Kahneman writes that some stereotypes are perniciously wrong, he is referring to such stereotyping as a key source of prejudice. In his wonderful book, Mistakes Were Made But Not By Me, the psychologist Elliot Aronson writes, prejudices emerge from the disposition of the human mind to perceive and process information in categories. Categories are nicer, more neutral words than stereotypes, but it is the same thing. Stereotypes are energy-saving devices that allow us to make efficient decisions on the basis of past experience, help us quickly process new information and retrieve memories, make sense of real differences between groups, and predict, often with considerable accuracy, how others will behave or how they think. We wisely rely on stereotypes and the quick information they give us to avoid danger, approach possible new friends, choose one school or job over another, or decide that the person across the crowded room will be the love of our lives. But when Kahneman also writes that hostile stereotyping can have dreadful consequences, he is really referring to sensitive social contexts such as hiring and racial profiling by, say, immigration authorities. He is not referring to the world of investing. In the world of investing, hostile stereotyping by Mr. Market can have wonderful consequences for the value investors. Take the case of the airline industry. Anyone who has read Warren Buffett's letters or watched his interviews on the subject knows just how bad the economics of the airline industry is.
Yeah.
Mr. Buffett, what prompted you to make an investment in US Air, given the fact that this is such a cutthroat industry and certainly not transparent and easily understandable?
Yeah. Well, I think that probably the best answer is temporary insanity. The fellow that runs the U.S. Air is a wonderful guy. I mean, but he just happens to be in an extraordinarily tough business. And the interesting thing is, I'd actually written something for Graham's book in the early 70s about how the airline business was about the toughest business there was. And the interesting thing, of course, is that if you go back to the time, and we're in the right state for that, if we go back to the time of Kitty Hawk, net, the airline transport business in the United States has made no money. I mean, just think if you'd been down there at Kitty Hawk and you'd seen this guy go up, and all of a sudden this vision hit you that tens of millions of people would be doing this all over the world someday, and it would bring us all closer together. I mean, you think, my God, this is something to be in on. And despite putting in billions and billions and billions of dollars, the net return to owners from being in the entire airline industry, if you'd owned it all, and you put up all this money, is less than zero. If there had been a capitalist down there, the guy should have shot down Wilbur. You know, I mean, one small step for mankind and one huge step backwards for capitalism. But anyway, so along comes 1989, and I've got a lot of cash, and no one misled me in any way, shape, or form. I mean, this is 100% my decision, and I put money in it. And Seth Schofield, you can't find a better human being or manager than Seth Schofield, but he is operating with revenues based on market factors and costs that are not based on market factors, and that's a recipe for a lot of trouble. So I now have this 800 number, and if I ever get the urge to buy an airline stock, I dial this number and I say, my name is Warren, I'm an airaholic, and then this guy talks me down on the other end.
You should be aware that the odds of making money in that industry are bleak. That's because the overall economics of the airline industry sucks. But that does not have to mean that we put every airline in the crappy business category in our mind. If you do that, then we will never invest in a Ryanair or a Southwest airline, both of which are solid businesses which have beaten market indices handsomely over the last several years. Perhaps the analysts who did invest in either of these two businesses thought differently from the market without falling for the prejudice of applying the crappy business label to them. Perhaps she dug deeper and found that both businesses had durable competitive advantages and were run by entrepreneurs whom Charlie Munger would call as intelligent fanatics. Perhaps she had reliable and persuasive evidence specific to those businesses which would go against the conclusion in the base rate that airlines are crappy businesses. Perhaps they were exceptional businesses which defied the rule. Perhaps she had the necessary arrogance based on fact that she was right and Mr. Market was wrong. Exactly this type of thinking produces exceptional returns. When Mr. Market is deeply prejudiced against what you know to be a wonderful business, that very prejudice creates a fabulous investment opportunity. And so let's empathize with Mr. Market and understand its prejudices in the pricing of moated businesses. But before I do that, I want to say some words of caution. First, these are the prejudices that I have found and exploited over the years, which means that there may be others which I have not found yet. Second, I only refer to prejudices in the pricing of moated businesses. To be sure, there are many other ways of practicing value investing, and the other kinds of value investing may result in your exploiting opportunities, prejudices which are very different from the one which I'm going to cite right now. Finally, there will be overlaps in the sense that sometimes you will find multiple prejudices in a single situation, and when that happens, you can expect what Charlie Munger calls a Lollapalooza outcome. My first prejudice is titled Marshmallows. Here I want to talk about the tendency of investors to categorize stocks or businesses as cheap or expensive based on their reported PE multiples. For example, many of my own value investing friends wouldn't want to buy into a business selling at a PE multiple of 25. That's a prejudice in my view for two big reasons. First, there's plenty of evidence which confirms the notion that businesses selling at PE multiples of 25 or above are expensive. By definition, a business that's expensive, if purchased at that expensive price, should deliver poor investment returns over the long term. But there's plenty of research which shows that's not the case. While the average business may well be overpriced at 25x, that doesn't mean that exceptional ones are also expensive at that market valuation. Charlie Munger's observation that if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with one hell of a result, is obviously applicable over here. And the second reason is that in a moated business, reported earnings often understate true economic earnings. That's because there is money, that's because money spent on successful moat expansion activities is charged off to P&L, but it should be treated as an expenditure with benefits spanning more than a year. This is the key point that Buffett has made in his letters and which, in my view, is often not fully understood by investors. Charlie Munger's observation that almost all good businesses engage in pain today, gain tomorrow activities also means that after making the necessary adjustments, one would find that the multiple of their economic earnings, the ones that really matter, are sometimes significantly lower than P multiples based on reported earnings. And so what looks optically expensive is really not that expensive. In my view, the market's tendency to categorize the business as expensive simply because it's trading at 25 multiple is an exploitable prejudice. Warren Buffett agrees. He wrote many years ago that the term value investing typically connotes the purchase of stocks having attributes such as low ratio of price to book value, price to earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principles for obtaining value in his investments. Correspondingly opposite characteristics, a high ratio of price to book value, a high price earnings ratio, and a low dividend yield are in no way inconsistent with a value purchase. At this point, you must be wondering, why did I title this part of the talk as marshmallows? The answer to that question lies in a famous experiment, which I'm sure many of you have heard of, the famous marshmallow experiment conducted in the neighborhood in Stanford University. This experiment is beautifully described in this video.
I'm here because I have a very important message. I think we have found the most important factor for success. And it was found close to here, Stanford. Psychology professor took kids that were 4 years old and put them in a room all by themselves. And he would tell the child, a 4-year-old kid, Johnny, I'm going to leave you here with a marshmallow for 15 minutes. If after I come back, this marshmallow is here, you will get another one. So you will have 2. To tell a 4-year-old kid to wait 15 minutes for something that they like is equivalent to tell us, we'll bring you coffee in 2 hours. Exact equivalent. So, what happened when the professor left the room? As soon as the door closed, 2 out of 3 ate the marshmallow. 5 seconds, 10 seconds, 40 seconds, 50 seconds, 2 minutes, 4 minutes, 8 minutes. Some lasted 14 and a half minutes. Couldn't do it. Could not wait. What's interesting is that 1 out of 3 would look at the marshmallow and go like this. Would look at it, put it back. They would walk around. They would play with their skirts and pants. That child already at 4 understood the most important principle for success, which is the ability to delay gratification. Self-discipline, the most important factor for success. 15 years later, 14, 15 years later, follow-up study. What did they find? They went to look for these kids who were now 18 and 19, and they found that 100% of the children that had not eaten the marshmallow were successful. They had good grades, they were doing wonderful, they were happy, they had their plans, they had good relationships with the teachers, students, they were doing fine. A great percentage of the kids that ate the marshmallow, they were in trouble. They did not make it to the university, they had bad grades, some of them dropped out, a few were still there.
Why did most kids not wait? 2 out of 3 kids didn't wait. Well, if you think about it, they were implicitly using DCF, discounted cash flow, to make their choice. The kid who could not wait for 15 minutes for another marshmallow was implicitly at the subconscious level using a very high discount rate to determine the present value of the second marshmallow. To her, 2 marshmallows 15 minutes later were not worth as much as 1 marshmallow now. And the only way that can happen if she was using a very high discount rate. If kids can be myopic and overweigh instant gratification and underweigh delayed gratification, why not Mr. Market? Indeed, Buffett offers clues as how he thinks about discount rates for valuing a business. He says, when we look at the future of a business, we look at riskiness of being as a set of as a sort of go, no-go valve. In other words, if we think that we simply don't know what's going to happen in the future, that doesn't mean it's risky for everyone. It means we don't know, and it's risky for us. It may not be risky for someone else who understands the business. However, in this case, we just give up. We don't try to predict those things. We don't say, well, we don't know what's going to happen, therefore we'll discount the cash flows that we don't know at 9% instead of 7%. That's not a way to approach it. This is very fundamental, because what he's saying is that in order to value a financial asset, he uses the same discount rate. He doesn't use the idea of equity risk premium at all. Clearly, Buffett does not use an equity risk premium in the discount rate. He does not heavily discount distant cash flows, delayed gratification, like the children in the marshmallow experiment. And that gives him an edge over competition, because he can pay up for quality without actually overpaying for it. The second prejudice I'll call as hidden champions. This is taken from a wonderful book called Hidden Champions. In this book, the author writes about extremely successful businesses that remain below the radar for long periods of time. Hidden champions, really. Large corporations, he writes, are the subject of close and constant scrutiny by academic researchers, analysts, shareholders, and journalists. Hidden champions, on the other hand, remain virtually unexplored source of knowledge. Scattered around the globe, thousands of these highly successful companies are concealed behind a curtain of inconspicuous invisibility and, in some cases, deliberate secrecy. This applies to the products these companies make and how they beat their competition, and even more difficult to research how they are managed internally. Even their names are known to only a handful of experts, consultants, journalists, and researchers. This secretiveness contrasts starkly with dominant positions the hidden champions enjoy in their markets. Many of them have global market shares of more than 50% and even hold shares in the relevant market of 70 to 90%. On average, they are more than twice the size of their strongest competitors. Only a few large multinationals achieve comparable market positions. The question that he asks, I think, is very important. Why does this happen? Why do these outstanding companies kind of remain below the radar? He offers many reasons, but the most obvious one is that the large number of the products offered by hidden champions go unnoticed by consumers. Many of these companies operate in the hinterland of the value chain, supplying machinery, components, or processes that are no longer discernible in the final product or service. As a result, the products lose their distinct identity or autonomy. That's the most interesting part for me. The products offered by hidden champions go unnoticed by consumers. Such businesses not only go unnoticed by consumers, I think they also go unnoticed by investors. A related tendency of the market is to categorize all businesses in a commodity industry as crappy businesses, something that I referred to in the context of the airline industry just now. Indeed, some of the best ideas in which my colleagues and I have invested have exploited these prejudices of Mr. Market. Mispriced B2B businesses which have business models as good or even better than some exceptional B2C businesses, as well as profitable niches hiding inside commodity industries. Indeed, Buffett and Munger loved the idea of investing in profitable niche businesses operating in industries with commodity characteristics. For example, Berkshire owns several profitable niche insurance operations. And I quote, "The insurance industry is cursed with a set of dismal economic characteristics that make for poor long-term outlook, hundreds of competitors, ease of entry, and product that cannot be differentiated in any meaningful way. In such a commodity-like business, only the low-cost operator or someone operating in a protected, usually small niche can sustain high profitability levels." Charlie Munger has said that in nature and in business, specialization is key. Just as in an ecosystem, people who narrowly specialize can get terribly good at occupying some little niche. Just as animals flourish in niches, similarly, people who specialize in the business world get very good because they specialize, frequently find good economics that they won't find in any other way. So I think it makes a lot of sense for investors to look for profitable niches in commodity industries which are priced and mispriced rather as commodity businesses. That's the categorization that the market is applying to them. That's the label that the market is applying to them. Painting everything with the same brush, throwing the baby out with the bathwater. The third prejudice that I have is called learning machines. Now, you live in that part of the world where making mistakes and encountering failures is celebrated and is often a precondition for getting funding from VCs or even a job. The world out there is actually quite different from all of this. Where I come from, Mr. Market has a prejudice against people who make mistakes. For a while, it is unable to distinguish between people who make mistakes and will continue to make them and people who Charlie Munger would call as learning machines. In other words, it has a tendency of categorizing all mistaken entrepreneurs as dumb people. This prejudice doesn't last forever, of course, but sometimes it lasts long enough to make it exploitable. A few years ago, I invested in a business which at one time was in bankruptcy, but is today one of India's most profitable listed businesses as measured by return on invested capital. The chief cause of bankruptcy was a series of mistakes made by its founder. Unlike many other entrepreneurs, however, this entrepreneur was not only candid about his mistakes, he was also determined not to make them again. And he didn't. He got out of a lot of businesses that destroyed value and became really good at doing one thing very well. He outsourced manufacturing operations to 8 vendors, which dramatically boosted returns on capital. He got out of debt and has a liquid balance sheet with surplus cash and has committed that he will never borrow money again. He made a very wise acquisition at a ridiculously low price, which not only gave him access to important patented technology, it also opened up a new big market for him. And there was this period of time when the market pretty much ignored all the lessons he had learned and the stock continued to languish, even though during that time his company became the world's most dominant player in their industry. But as Graham says, in the long run, the market is a weighing machine. And that's how he treated this business too. Today, it is far more appropriately valued and it is obvious that Mr. Market has overcome its prejudice against this particular learning machine. There's a pattern here, of course. I think value investors should consciously look for learning machines which haven't been forgiven for their past mistakes. That's the prejudice worth exploiting. The fourth one, I have 5 in total, is called serial acquirers. It's a well-known fact that most acquisitions don't create value. That's because the acquirers become over-optimistic about the prospects of targets and overestimate the synergies of acquisitions. So we know the baseline information for acquisition really sucks. So statistically speaking, the stock market is absolutely right to view serial acquirers with a great deal of skepticism. But this doesn't have to mean that all serial acquirers will destroy value. There are a few exceptions and sometimes the market is prejudiced against them. The market's tendency to categorize all serial acquirers as value destroyers is an exploitable prejudice in my view. There are examples, let's look at the common factors in these serial acquirers which do create value. There are a few examples. Henry Singleton was one. Warren Buffett clearly is one. Prem Watsa of Fairfax Financial is another one. The common factors in my view are: 1, extreme financial discipline, that is willingness to walk away from a deal that doesn't make economic sense. 2, providing a permanent home to a promising business, which is something like private equity funds cannot do. 3, preserving the successful culture of the acquired business. And 4, providing growth capital for sensible inorganic growth through bolt-on acquisitions. For value investors, making an investment in such a business when the market is prejudiced against it makes a lot of economic sense because of the option value embedded in such a situation. Successful serial acquirers like Berkshire have carved out a niche for themselves to become preferred owners of wonderful businesses. This competitive advantage of sourcing deals not available to others has significant option value over time. The investor is, in effect, to borrow a term coined by Professor Richard Zeckhauser in his wonderful paper titled Investing in the Unknown and the Unknowable, a sidecar investment, which an individual who has exceptional sourcing skills and a track record of value creation through inorganic growth. The investor rides along in a sidecar pulled by a powerful motorcycle. The more the investor is distinctively positioned to have confidence in the driver's integrity and his motorcycle's capabilities, the more attractive the investment. Prejudice 5 is called freaks and misfits. Now, I'm almost sure you've seen this before. A few months ago, someone asked a question on Quora. The question is on the screen. And Elon Musk's ex-wife, Justine, gave an answer which went viral and ended up being quoted by New York Times, Vox, CNBC, CNN, the Huffington Post, and Time Magazine. Here's an excerpt from her reply. Extreme success results from extreme personality and comes at the cost of many other things. Extreme success is different from what I suppose you would call success. So know that you don't have to be Richard or Elon to be affluent and accomplished and maintain a great lifestyle. Your odds of happiness are better that way. But if you're extreme, you must be what you are, which means that happiness is more or less besides the point. These people tend to be freaks and misfits who were forced to experience the world in an unusually challenging way. They developed strategies to survive, and they grow, and as they grew older, they found ways to apply these strategies to other things and create for themselves a distinct and powerful advantage. They don't think the way other people think. They see things from angles that unlock new ideas and insights. Other people consider them to be somewhat insane. The term freaks and misfits, which might ring a bell with you, given the culture that we are in, it was taken from Justine. I think it's important for us to understand her perspective. And that is something that a professor from Harvard Business School, Joseph Bedaraco, offers as an explanation. Here is a professor who uses literary fiction to teach leadership to his students at Harvard Business School. In his book, Questions of Character, he writes, how does serious fiction help us understand leadership? The answer is simple but extraordinarily powerful. Serious fiction gives us unique inside view of leadership. In real life, most people see the leaders of their organizations only occasionally. As investors, this is exactly what we get to see. We don't get to see what is really happening. And only get a fleeting glimpse of what these leaders are thinking and feeling. Even interviews with executives have limits. Executives only say so much, and even when they want to be candid, sensitivities have to be observed, memory fades and sometimes distorts, and success crowds out failures. In contrast, serious literature offers a view from the inside. It opens doors to world rarely seen except on occasion by leaders' spouses and closest friends. Think Justine Musk. It lets us watch leaders as they think, work, hope, hesitate, commit, exult, regret, and reflect. We see their characters tested, reshaped, strengthened, or weakened. The reason why Justine's perspective is important for us is because, as the professor puts it, it opens the doors to world rarely seen, except on occasion by leaders, spouses, and closest friends. In my view, when it comes to evaluating the quality of extremely successful entrepreneurs in the early part of the journey, the market displays a prejudice. This prejudice is derived not only from the complex personality that some of these entrepreneurs have, many of whom are definitely not likable people, but also from a limited view about the individual in question that investors get. I've seen this prejudice play out over and over again. The market is just too judgmental about some of them.
Look at the cute dog.
All the boys are calling crazy girl. I hope she sings this tonight. I know. Hey, Dad, pull over. We need gum.
I'm on it. Oh, honey? Here's some money.
What do we got here?
Hello.
I see this play out over and over again in analyzing these human beings, these extraordinary human beings. The reality is that the riding on the coattails of such extraordinary human beings is a key source of compounding capital for public market investors. Charlie agrees. In an interview with Miguel Barbosa of Simoleon Sense, successful value investor Paul Lontis has said, the ability to identify a young Phil Knight, a young Howard Schultz from Starbucks, a young John Mackey from Whole Foods is becoming increasingly important. I'm typically attracted to a company because of the numbers. But what makes you enormously successful for your clients is when you identify qualitative factors that have yet to appear in the quantitative results. The key is to identify these situations early. You still have those opportunities when companies are small, but it's getting harder because there are many smart people looking. For example, if you see Progressive Insurance generating an 82 combined ratio and making 18 cents of every dollar on their underwriting before investment income, you might say, my God, State Farm is at 110. How are these guys so profitable? It's really hard to identify these unique teams and cultures, but if you can do it or get lucky, then you can do very well for your clients. By having an edge, you will avoid overpaying. You are protected on the downside and you have enormous upside because you are piggybacking on a visionary who's building an extraordinary culture with a long runway. Because of this mispricing, you can stay with them for 20 years. Furthermore, because you have done your research and you understand how this visionary is building the business and you have the confidence to survive all the vicissitudes of the market. So when you go through tough times, you recognize they have a stable competitive advantage. They've got better people, they're tenacious, and they're likely to come out stronger. It's an important distinction that I'm trying to make, that the qualitative is becoming more important. I still think quantitative features are subordinate to the business model and valuation, but the business model is infinitely more impacted by management and culture than it was in the past. I think it's terribly important for value investors to recognize that a key source of investment success is to become long-term passive partners with extraordinary human beings who many would regard as freaks or misfits. When George Bernard Shaw said that the reasonable man adapts himself to the world, the unreasonable one persists in trying to adapt the world to himself. Therefore, all progress depends on the unreasonable man. Was he talking about freaks and misfits? Shouldn't the label of freak and misfit not sometime be re-labeled as intelligent fanatics? That's what this bias is about. The representativeness heuristic, labels. We apply labels. And a label of a freak and misfit, which is a negative connotation, can easily be sometimes relabeled as an intelligent fanatic. And it makes all the difference. One of my key learnings from studying such people is that as an investor, I have to teach myself to overlook many of their personality traits, some of which are not admirable at all. Indeed, I think those traits are a consequence of their fanatic focus on their work. I have been consciously training myself to empathize with such extraordinary human beings. In his wonderful book, The Social Animal, Harriet Aronson talks about the insidious nature of prejudice. He quotes a fictional dialogue from Gordon Allport's classic book, The Nature of Prejudice. I think the dialogue is worth reading. Mr. X says that the trouble with Jews is that they only take care of their own group. Mr. Y, who is the prejudiced person, says, Mr. X is the prejudiced person, Mr. Y is the interrogator. He says, but the record of community chest campaign shows that they give more generously in proportion to their numbers to the general charities of the community than do non-Jews. Mr. X then responds, that shows they're always trying to buy favor and intrude into Christian affairs. They think of nothing but money, and that's why there are so many Jewish bankers. Mr. Y responds, but a recent study shows that the percentage of Jews in the banking business is negligible, far smaller than percentage of non-Jews. Mr. X then responds, that's just it. They don't go in for respectable businesses. They're only in the movie business or they run nightclubs. The dialogue illustrates the insidious nature of prejudice far better than the mountain of definitions. In effect, the prejudice Mr. X is saying, don't trouble me with the facts, my mind is made up. He makes no attempt to dispute the data presented by Mr. Y. He either distorts the facts in order to make them support his hatred of Jews, or he bounces off them, undaunted, to a new area of attach. A deeply prejudiced person is virtually immune to information at variance with his or her cherished stereotypes. As famed jurist Oliver Wendell Holmes Jr. once said, trying to educate a bigot is like shining light into the pupil of an eye. It constricts. While Aronson's words that a deeply prejudiced person is virtually immune to information at variance with his or her cherished stereotypes applies to many prejudiced human beings, they do not apply, if you think about it, to Mr. Market. That's because Mr. Market is a learning machine. He corrects his prejudices over time. while the 5 patterns of prejudice that I just outlined, they keep coming back in one form or the other, the prejudice against specific examples conforming to these patterns tend to disappear over time. We have a name for that, and we call that re-rating. I think there are 2 lessons here. The first one that I've already told you about. The second one is that we should look at Mr. Market with some respect. After all, he is far less prejudiced than us. Why couldn't we learn to get rid of some of our own prejudices from him? Thank you.
Thank you, Sanjay. This was great. So we'll open up to some questions right now.
Thank you, Sanjay, for the wonderful presentation.
Thanks.
I had a question about the last one, misfits, and maybe a little bit about the learning machines. If we take Warren Buffett as an example, you could say, ignoring the past decade, most of the investments he's been made are in a handful of companies. Geico, American Express in the beginning, in the 60s, American Express again in the 90s, and a few handful of others. Almost all of them he bought at points of maximum pessimism. I can't maybe recollect any example where he said everything is great with the business and here's a misfit, here's a learning machine, and I'm going to buy it. I think Coke may be one such example, but there are more examples where it was essentially he was focused on the long term. There was something temporarily wrong with the business and he bought it. He talks about jumping 1-foot hurdles. Sounds to me this is more than a 1-foot hurdle, identifying a misfit or a learning machine. But maybe I don't know any examples. Maybe you can enlighten us.
Sure. I think it's important to recognize that the examples that you cited refer to what he's done in public markets, and what he does in public markets actually is a very small portion of what actually really happens in Berkshire. As you probably know, that they have, I think, more than 80 businesses now in their portfolio, which they own wholly or almost wholly, and they have been generating a lot of cash. So they have been, all these businesses. When I talked about the idea of misfits, I was really referring to the apprehensions that public market investors have about the character of these people. Sometimes these people do things which look very, very odd, and they are odd in a sense that, after all, these are extraordinary human beings. They don't do things which look ordinary. And I'm not talking about innovation. Of course, that is one aspect. I'm not talking about risk-taking or innovation or any of that. I'm talking about things that appear to be sometimes unethical, but they really are not big deal in the whole totality of things. So I'll give you an example without naming names. There are businesses which I have looked at in the past where the entrepreneur may have paid himself a really nice salary. Now, if you focus only on that aspect, and it may turn out to be something like 10% of profits. But the fact of the matter is that he's an extraordinary human being, and 10% does look big. But if you look at the overall situation, if you look at the fact that what he's accomplished and the kind of moat that he has built, in the totality of things, you just suck up, and you have a choice. Either you want to be a partner with him or not. But I think the opportunity cost of not being a partner with a guy like him, is an extraordinary person, is actually quite high. So you have to swallow a lot of things which may, under normal circumstances, be something that you might want to walk away from. And the reason is because of the extraordinary moat that he has created. So that's just one example. I'll give you a few other examples. I know of a business where the premier credit rating company in the country resigned the assignment. Why? Because he's not cooperating. He basically told them, buzz off, I'm not going to give you the information. And if you remember, Charlie Munger did pretty much the same thing with the auditors in Daily Journal, and he had a huge tiff with the auditors. That's the point I'm making. These guys have what Charlie Munger called a lot of chutzpah. They absolutely don't give a shit about what anybody else think about them. They think they're absolutely right, and reminds me of what Charlie Munger has said, that never underestimate a man who overestimates themselves. And all entrepreneurs overestimate themselves, and overconfidence is a very important aspect of capitalism. What I'm trying to distinguish is between the dumb fanatics and the intelligent fanatics. And I gave a talk some time back when I made that distinction. where I profiled 7 intelligent fanatics from India, and I gave gave a kind of a checklist as how I think about intelligent fanatics versus dumb fanatics. So one of them is debt or risk management. So a dumb fanatic they're all overconfident whether you're dumb or not, but they bet the bank, and sometimes they get lucky. Most of the times they blow up. So they don't know anything about risk management. Whereas an intelligent fanatic would make series of bets. He's like writing insurance, and many of those bets will fail. But even if all of them fail, that doesn't destroy the company. So that's one. The other is they almost certainly don't rely on other people's money. They use their own capital. They don't borrow money. So they don't create financial structures where they are dependent upon the kindness of strangers over there. So I see that. I see fanaticism when combined with intelligence, that combined together makes a very nice combination. And when you see that, it's so rare. If you look at the history of wealth creation, that when you find this fanaticism with intelligence and integrity, when you combine those three, and if you can get it along with a reasonable business, and that's the point I'm making here, which is the point that even in commodity industries, some entrepreneurs have the ability to carve out a niche, which is very hard to copy. And that niche is coming from the fanaticism of the entrepreneur, and is a very smart person. And therefore, if you can become partners with him on favorable terms in terms of valuation and all of that, then you can ignore a lot of other things, which is what Elon Musk's ex-wife was saying, that they are crazy in many ways. These guys are or women, they are very nutty in many ways. But I think you should not over focus on those matters. You should only focus on the track record, what they do, how they run their business operations.
So if I can just push that question a little bit further.
Yes.
So not to say that there are no intelligent fanatics and so on, but to borrow that phrase of whether it is actually a 1 foot hurdle versus a 6 foot hurdle, so to say.
It doesn't have to be. See, the point is, if you're going to see, what are we trying to do here? We're trying to compound capital, right? We're doing it sitting in our offices in air conditioned environment without stepping out, without actually kicking tires. We try to become rich. So it shouldn't be easy. I don't think the idea of compounding capital at superlative rates of return over long periods of time should become extraordinarily easy for anybody. If it was, then those returns will kind of go away. So I don't think it should be that easy. When Mr. Buffett talks about 1 foot hurdles, he's talking about his ability to predict the fundamental economics of a business over long periods of time. And believe it or not, many businesses that he has invested in are actually quite complex. So for a lot of people, to the ability to understand super cat insurance is actually very, very difficult. But he has done that. So he defines the circle of competence and he tries to stay within that circle of competence. And I think that's a wonderful model to have. But to assume that you will find very simple things to do all along, I think that's something which I don't really believe in.
I have a two-part question. One is that the stereotyping, is it correct or incorrect, is often found in the hindsight, with the benefit of hindsight. With these prejudices that you listed, all the 5 of them, are there certain tips or further shortcuts which you can tell to distinguish between what could be incorrect assessment of prejudice and which the market, which would create over time, or like how do you distinguish between luck and skill and define this? And
the track record. You're really looking at the long-term track record. If it was all luck, then over a period of time that would kind of go away, right? What I'm trying to illustrate is the point that there are these patterns that play out. What we're trying to do is that I picked just one heuristic, the representative. There are many others. I just picked one and I tried to think about the various manifestations in which it occurs, which creates tradable opportunities for public market investors. What I found was that the whole idea of labeling, and I mentioned that some time ago, that intelligent fanatic is just a label. To somebody else, it might look like a freak person, but to somebody else, it could be an intelligent fanatic. But what is the truth? The truth lies in the numbers. The truth lies in what they actually accomplish. So what we're really looking at is that, for example, in an industry with subnormal profitability, take airlines, we saw that, there is one company which has extraordinarily profitability. So we want to question why. Why is that happening? Is this luck or is this skill? And to answer that, you have to look at record over a long period of time. You have to look at the track record of that business during periods when the airline industry was going through horrible periods of time. And if you do that for Ryanair and for Southwest, you will find that they had some unusual fundamental financial performance even during periods when the entire airline industry in the world was going through a terrible phase. So you try to look for exceptional, outstanding performance over long periods of time, and then you kind of attribute that to luck or skill. And sometimes, occasionally, you will find that there is some skill out there. The beauty is that the market is not able to distinguish that. Market has this labeling problem. Market thinks, oh, it's a crappy business because it's an airline industry and because Warren Buffett said so, therefore it should not be priced as a really good quality business. But if you ignore for the moment, if you de-bias yourself, if you remove the name, the label of the airline industry and think like a Graham who said once, that I want to be completely unbiased, I don't want to even know the name of the business. If you just look at the actual objective data, you will find staggering financial performance. You won't know what the industry is. Just because you know that the industry is an airline industry and there is this label hovering around in your head that in airlines are, generally speaking, and that's the correct label, crappy businesses, you tend to misjudge what you are seeing. And I think that's a bias that was worth of getting out of, because that's an exploitable bias. That's a bias that the market will itself get out of, which is where the opportunity lies. Because you're trying to buy it when the market still has that bias, and when the market doesn't, the stock would have been re-rated and you would have made a lot of money. You see, the whole idea that in my work in investing in moated businesses, what I found was that the idea that moats can only be found in some industries and never in other industries, that itself is a prejudice. If you work hard enough, even in businesses which have commodity labels, you will find moated businesses, usually in niches. And when you find them, you may often find that the market is still treating them as a commodity business. That's the opportunity.
So you spoke about many value investors shying away from buying 25x multiples and higher than that, I think you also spoke about intelligent fanatics and people who are driven and obsessed by growth and returning profits. I guess the question I have is, where does a healthy margin of safety come into all of this? I think one of the reasons I shy away from a 25x multiple is, what's my margin of safety, right? I look at the previous P's it's been trading at, I look at its growth. When I'm buying something at a P by E of 25, I'm expecting like 10, 15% growth year on year for the next decade, right? So I just wanted to hear your thoughts on that.
Sure. I'll answer that in two parts. Firstly, when you think about PE multiple, the P part is obvious because it's observed from the market. There's the E part, which is quite subjective. And I mentioned this, in my judgment, many moated businesses, the E part is actually higher than what you see over there, for reasons that I explained. And when you make those adjustments, then what looks expensive is not that expensive. It's cheaper. That's one. Secondly, if you look at a business which generally has a moat, that means it has strong entry barriers and has the ability to compound capital at lucrative rates for long periods of time. If you do the math, as Charlie has mentioned, that even if you pay a 25 P multiple for a business which is compounding capital internally at a fabulous rate and has reinvestment opportunities, even if it's the duration of the opportunity, if you extend that from 5 years to 10 years and from 10 to a longer period, if you have that conviction, then it becomes quite attractive. I think you may be referring to some businesses in this part of the world where the growth rates are actually lower. Where I come from, growth rates in many businesses are actually very high. They are in, sometimes in high double-digit percentage numbers.
In context of investing in Asian countries, and two things that come up and which cloud every other kind of judgment, for right or wrong, is authenticity of what you see on the books. So, first of all, a company could be doing well for 10 years, 20 years, and these are very, very big numbers. Some company doing good for 2 decades. And eventually something blows up, and what you figure out is that there was a very, very big fraud going on. It could be numbers could be cooked, auditors were being bribed, and all those things. it happens more in Asian countries than probably North America.
Is that a prejudice?
Could be, but when you're identifying an individual company and you see returns which far surpass the returns of the same industry, of other companies in the same industry, one thing that one also needs to scrutinize is there some kind of a fraud that's going on over there?
Absolutely. I mean, that's the whole point of being an analyst, is that you have to be skeptical. You have to have the diligence. You have to be able to check the numbers. You have to do background checks. There are a lot of things that you need to do to make sure that the numbers are right. If the numbers are not right, then obviously you shouldn't be invested in that anyway, because if they can cook the books, and you really don't want to be a partner in a business run by a person who is cooking the books, right? So I think it's absolutely imperative that you do that test, and it doesn't matter which country you are in. I think that's, there was a Madoff here and there was an Enron here as well. So it's something that is a required discipline for any value investor to be able to ascertain whether the numbers are cooked or not.
So how to do that?
I can do a whole course on that.
Okay.
Yeah, but we can talk after this. There are some things. It depends on the industry. If you have to do that in a banking industry, it becomes far more complex. It's a very different kind of a business model. If you're looking at a simpler business model, then there are ways of doing that. And I'll be happy to talk to you after about this.
So, because this was a central point in at least the last half of your talk, some of us were at the Daily Journal meeting where Charlie Munger was asked a question about Elon Musk. So I have a couple of the sentences from Bloomberg Business's website. And Charlie says, "I think Elon Musk is a genius, and I don't use that word lightly. He's also one of the boldest men who ever came down the pike. So put me down as saying I've always been afraid of the guy whose IQ is 190 and he thinks it's 250. So like you said, never underestimate a person who was overconfident. So, but I think identifying intelligent fanatic, so to say, versus investing in Tesla or BYD, aren't they two separate questions?
They're very different questions. What I'm looking at is, without giving up on Buffett kind of thinking, without giving up in the idea of investing in highly profitable, dominant businesses which are already making a lot of money and paying reasonable multiples of their earning power, particularly when they run by an intelligent fanatic, is a great combination. I'm not recommending Tesla, nor am I recommending Amazon.com or any of the businesses that you might relate to the idea of intelligent fanatics. I'm just saying, because you can easily relate to those human beings, that there are these people out there. They're not as well known as these human beings are, but there are these people out there. They are achieving global dominance, and it's just a label. The point I want to make is that this whole talk was about labels, and labels as prejudices, and therefore sometimes the prejudice which is labeled as a freak or a misfit is actually the correct label to apply to that is that of an intelligent fanatic. And it doesn't have to be an Elon Musk. It doesn't have to be a Jeff Bezos or anybody for that matter. It has to be somebody who's really passionate, is got integrity, is completely driven, is not dumb in the sense that it will not blow up the balance sheet on a single idea, will not lever up the balance sheet. It's conservative and aggressive in a combination that is reflective of intelligence. And if you can find that combination along with a great business or even a reasonable business, that's the point I'm making, that you don't have to look for the best quality businesses out there because they get priced out. In a pari-mutuel system of the stock market, you can't bet on the best horses, because the best horses, the odds change. You are betting against other investors. And therefore, what you should really be trying to do is find reasonable quality businesses which have the taint of a commodity on them, but the particular business that you are looking at is an exception. It's an exception because it's run by a fellow or a bunch of people who are really exceptional, and you have got data to validate that. You're not just dreaming it up. You're not just saying because you read up a prospectus of an IPO and you think that he will do wonderful things and you believe he'll do wonderful things. You actually have seen that information. You've seen that they have actually delivered under terrible conditions fundamental performance which is outstanding in relation to the peers in the industry, and you think that you can attribute that to certain causal factors that you can identify, and those factors will remain for a long time. If you can find that with reasonable valuation, even in a normal industry, not an extraordinary profitable industry where everybody makes money, I think it's a wonderful combination because the market is mispricing it.
Great. So thank you, Sanjay, for a fantastic talk. It was a pleasure to have you here.
Thank you. Thank you for having me.